Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. So the US and Taiwan have a trade deal. It lowers tariffs to 15% from the previous 20%. And that means that US tariffs on goods from Taiwan are now on par with those for Japan and South Korea. As a part of the trade deal with Taiwan, semiconductor companies will be making at least direct investments of around $250 billion toward American energy and artificial intelligence operations. Here is Bloomberg's Michael Shepard.
It's been a top priority for officials there in Taipei, but also here in Washington, because Taiwan is such a crucial source of the chips that go into artificial intelligence and AI data centers across the U.S. and around the world. And they wanted to make sure they get this locked into place and that they can have some assurance that supply lines to the island are really in a good place.
That is Bloomberg's Michael Shepard. Now, this trade deal comes as TSMC, the world's top maker of those AI chips, released earnings. And at the same time, Taiwan Semi earmarked a hefty increase in CapEx spending for 2026. Here is Bloomberg analyst Matthew Bloxham.
They're talking about $52 to $56 billion of capital spending in this coming year. That's about $6 to $10 billion, or 15 to 20% higher than the market was expecting, and a big step up year on year, over $10 billion up year on year.
That is Matthew Bloxham from Bloomberg Intelligence. By the way, U.S. listed shares in TSMC picked up nearly 4.5%. In the overall equity market today, we had small caps continuing to outperform. The Russell 2000 gained more than 0.8% and beat the S&P 500 for a 10th straight session. The S&P was up just 0.2% today. For a look at market action, I'm joined by Rob Haworth. He is Senior Investment Strategy Director at U.S. Bank Asset Management Group. Rob is on the line from Seattle. Thank you for being here. I'd like to begin by getting your take on this rotation that we've been seeing into small cap stocks.
Yeah, we really saw this even as we finished out 2025 over the last month and a half, was we were starting to see the market look towards rotation. And I think that's one, the impact of lower Fed interest rate costs, right? The Fed having already lowered rates by 0.75 of a point is giving some room for small caps to run. And then two, we're seeing the beneficiaries of artificial intelligence really start to broaden out, first with healthcare. That's helping this rotation strategy. And then three, earnings expectations are picking up across the spectrum, both large and small. And part of that is probably the look ahead to tax season when consumers will start to benefit from some of the tax cuts that are part of the One Big Beautiful Bill Act. So that's really starting to drive, I think, a broader economic cycle here than what we saw over the last 6 months of the year, which was mostly artificial intelligence driven.
So today's economic news, I think, by and large, was above expectations. Jobless claims unexpectedly down to the lowest level since November. And then we had the manufacturing survey for the New York area. Activity expanded. And at the same time, a gauge of prices dropped to a near one-year low. When you hear points like that, does it create a little bit of uncertainty in terms of what the Fed may be doing this year?
Well, I think it certainly gives the Fed room to evaluate data as we press ahead. We know some committee members are very convicted that we need to have much lower interest rates right now. But we've heard from other speakers where they're taking a little more of a wait and see attitude. And I think as long as the economy is holding together, and we've got a lot of stimulus in this pipeline between One Big Beautiful Bill Act, the World Cup is going to push up spending here in the U.S. The 250th anniversary celebration is going to help spending here in the U.S. So there's some stimulus coming through here that I think can continue to drive the story and maybe give the Fed time to evaluate the incoming data, because certainly the jobs data has been pretty solid. The inflation data is slowing, but not quickly. And so the Fed, having done 0.75 of a point of cuts to finish the year, maybe can take some time to evaluate. The market and our base case is still, we probably get 2 or 3 cuts this year, but they don't have to happen right away.
I'm curious to get your take on what's been going on in the bond market with this very low volatility that we've been seeing. I think the 10-year Treasury, the yield right now is headed for a 5th straight week of minimal change. And if you talk to folks on the street, they seem to be a little anxious here because in previous cases like this, where you've had a constricted range of yield, it's been followed by sell-offs. How do you make sense of the low volatility in the bond market?
Well, I think we just don't have enough data yet to tell us the direction here, right? There's been concern that we have elevated inflation or perhaps we get rising deficits that could really push rates higher. On the other hand, if we were really getting a weaker labor market, right, that could easily push long-term rates lower because of a growth scare. For now, I think we're stuck waiting for that data to come in. We're still not all caught up on data from the government shutdown. We don't yet have PPI through year end. We're not going to get PCE through year end. We don't have personal income data. We're not going to get fourth quarter GDP growth by the end of the month. We're still finishing up Q3 data. So I think there's a lot of data that bond investors would really like to see to understand where they should probably price fixed income at this moment. And so I think we're really waiting for that. Then there's the additional factor with the president directing Fannie and Freddie to start purchasing more mortgage bonds that's going to hold interest rates in there as well, right? You've got more liquidity being absorbed in the market. So for those who were planning to buy mortgage bonds, they may have to be buying longer term treasuries at this point, which is also helping keep that volatility low.
We've seen a lot of influence from geopolitics, particularly in the crude oil market. President Trump yesterday signaling he may hold off on attacking Iran for now. Interesting piece in the Wall Street Journal indicating that Trump was told an attack would not guarantee the collapse of the Iranian regime. In fact, it may even spark a wider conflict. So today, WTI broke down below $60 a barrel. I think we were off about 4.5% in New York trading. That's obviously a positive when you look at the inflation story. But how are you evaluating the impact of geopolitics on overall trading right now, particularly in the commodity space?
Well, it's certainly been fairly muted, but I think that's the muted aspect, whether it's in oil or equities, really, I think, in our view, reflects that we haven't seen a lot of ongoing engagement in areas outside of Russia, Ukraine, which kind of continues and the markets become somewhat numb to at this point. As long as we're not getting boots on the ground, right? We had no boots on the ground stay in Venezuela. We didn't get an attack in Iran. I think the market can adapt to that. Additionally, when I start to think about the oil market, the issue there is you have a very well supplied market at this point. And unless we start taking more OPEC barrels off, which OPEC's plan is to add barrels, it seems like prices can stay in this relatively low zone for some time, as long as we're not changing that supply equation.
It's been very interesting trading for the last couple of days in the precious metals market. There was a 4-day rally in silver that saw the price increase something greater than 20%. But we had a pullback late in the day, Wednesday, U.S., during the Asian session. Right now, I'm looking at the spot price down roughly 1.5% at around $90 an ounce for silver. Talk to me about what you believe to be the influences on the precious metals market.
Well, I think we've seen a couple of things on precious metals. Last year, especially early in the year, it seemed like global central bank buying was really the key driver, and then speculators have taken over as we've seen higher ETF flows in both gold and silver, and more demand across the market. We don't yet here in New York have an update on the CFTC data. We're still probably a week away from getting current on what's going on in the futures market and how extended speculators could be there. But in general, we've seen rising speculative demand as silver is caught up in terms of its historical relationship to gold. And then you have, I think, investors trying to anticipate where central banks may go, given that we continue to see kind of geopolitical uncertainty and risk. And so I think that's been a key driver for prices and maybe has gotten them to a bit of an excess speculative point at the moment. That doesn't mean in our estimation that we won't get further gains as we look through the year, but it does seem like we're getting to a point where the market probably needs to consolidate given how stretched that price action is in both gold and silver.
I want to get your take on the AI trade vis-a-vis Taiwan Semiconductor. We learned today that the company has earmarked as much as $56 billion in CapEx for 2026. That seems to suggest that the company's got a lot of confidence in the longevity of this AI boom. Do you share that enthusiasm?
We are very enthusiastic here, and I think in particular the reason we point to that is not because of the investment cycle, but rather the use cycle. We're starting to see those use cases get built out. Healthcare has been the primary beneficiary. We see that starting to really use AI and bring that into its system. But that's a lot of what we hope to see as we move through earnings season, fourth quarter, and especially first quarter this year, is more of the profit and use cases being built out and explained by companies for artificial intelligence. So the investment cycle needs to continue, but the use cases are starting to show up. And that tells us there's still legs to this rally as companies start to really bring artificial intelligence into their businesses and create efficiencies and create profits.
Are you seeing opportunity these days outside the U.S. in any offshore market?
Actually, yes. We do think global markets, interestingly, broadly, have significant opportunities. And interestingly, if we look at performance, if we think about 2024, we saw very strong performance for developed markets, for emerging markets, and U.S. dollar weakness. This year, they're actually leading the U.S. again to start the year, and yet we're seeing U.S. dollar strength. And what we think is driving that is a couple of things. One, you're seeing higher earnings expectations, and part of that is many foreign economies, Japan would be the exception, were early in their rate cuts, and that really is helping to support their economies and to support their earnings cycle. And two, we've seen the global economy really rebalance around trade, and that's starting to benefit companies outside the U.S. as well. So it looks like we're getting kind of an earnings resurgence outside the U.S. And while we're not, kind of bearish on the U.S., we're bullish on the global story. We think there's much more room for a global story in investors' portfolios in the year ahead, much like we saw in 2025.
All right, Rob, we'll leave it there. Thank you so very much. Rob Haworth is Senior Investment Strategy Director at U.S. Bank Asset Management Group, joining from Seattle here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Let's take a closer look now at TSMC. The company reported strong results and an ambitious spending plan that reverberated across equity markets in both Europe and the U.S. We caught up with TSMC's Chief Financial Officer, Wendell Huang. He spoke with Bloomberg's Annabelle Drulers in Taipei. And the conversation started with a question about TSMC's spending plans in the U.S.
It really depends on customer demand. In the U.S., a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over
Yes.
the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then. CapEx, it's $52 to $56 billion.
For this year.
Yeah, for this year. So can you tell us exactly how much of that is going to the US, given you've got such a big focus on the capacity build out there?
We don't just break down those numbers, but we do tell people that in the next 3 years, the total CAPEX is going to be significantly higher than the number in the past 3 years. So that is evidence of our strong conviction in the AI megatrend.
Our sources are saying, for instance, at least 4 additional fabs could be added in the US, in addition to what's already been pledged. Is that realistic?
It depends on customers' demand. We are looking at very strong customer demand.
Could you give us a number?
We don't have the number now.
Do you want to ask about Intel as well? I'm wondering whether you see any potential for collaboration with the business, given they've got very strong expertise in advanced packaging technology in particular. Could that be an area for you to work on, given you're already outsourcing this to third parties with your constraints?
it depends if it makes sense to the customers and also if it makes sense to our wafer business. The advanced packaging business to us is a strategic. It enables our wafer business. So if there are more alternatives in the market which can enable our business, we can consider that.
Would you weigh up investing in Intel just like some of your biggest customers have done?
No discussion at all. What I'm trying to say is it can be considered.
Taiwanese dollar, in our survey of different FX strategists and analysts at Bloomberg, they're actually saying it's going to end the year at 30.9. So what is the impact to you if you see that further sort of strengthening, and what sort of headwind does it represent?
Foreign exchange rate between US dollar and NT does affect our profitability. In the past, for every percentage change in foreign exchange rate, it will affect our margins, gross margins and operating margin by 40 basis points. Nowadays, when the margins are higher, the impact become less sensitive. So nowadays, it's about 30 basis points, either way.
And how are you looking at hedging strategies as well?
The easiest way is to sell US dollar into NT. However, the market impact should be considered. If we're not able to sell all these, then we will do the forward contract. And if we still cannot accommodate all the positions, then we will continue to do moving the US dollar to the offshore entity, which has US dollar as its functional currency.
That was TSMC Chief Financial Officer Wendell Huang speaking with Bloomberg's Annabelle Drewlers in Taipei and bringing it to you here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.